Good afternoon, everyone. This is Kim Schmidt. I'm the executive editor of Farm Equipment Magazine. Welcome to our latest webinar, KPIs, OEM Goals, or Winging It, What's Best for Your Dealership, in conjunction with Pinion. Today's presenters is Mark Johnson. Mark proactively counsels business owners on financial and tax matters in order to position them well for growth and business succession. He works primarily with equipment dealerships throughout the U.S. and has for 20 years. Before Mark gets started with his presentation, just a couple of housekeeping items. On your screen, there's a control panel with a Q&A icon. You can submit questions here at any time during the presentation, and then time permitting, we'll try to answer as many of those as we can following Mark's presentation. And then, like always, we are recording the webinar in case you want to go back and rewatch it later or share it with anyone else at your dealership. With that, we are ready to get started. Thanks again for joining us, and you can take it away, Mark.
Great, thanks, Kim. Appreciate it, and I appreciate those of you that were going to do this last week, and we had a little emergency come up that sometimes happens, and so I appreciate your patience and understanding on coming back this week. We now we're on a Friday afternoon instead of a Thursday afternoon, which is a lot different for your schedule. So hopefully I get through this quickly and efficiently for you, but with lots of information, and then those that weren't able to join today live will be able to get the recording. So all is well now. The emergency is over, and it turned out well. So again, thanks for your patience on that. Just a little bit about why maybe you can listen to me today and know that I've got some information that's valuable. Just Pinion, if you don't know, long ago we were Kennedy & Co., and then we were KPIs, and now we're Pinion. All that just means we changed our name, and marketing changed our name for us along the way. We've had mergers and acquisitions and things like that, and got a lot bigger. My particular practice in our firm is just equipment dealers. So all of my clients look exactly like those of you on the phone. As a frame of reference, most of my clients, because I'm going to show a lot of client data up here, I'm going to call them the Pinion dealerships. None of them are Pinion, right? We don't own any of them. It's just the clients that we work with and the information that we're able to gather from them. So most of the dealerships that I work with, we do their audit and tax work and that kind of thing. Some of the dealerships, we only do mergers and acquisitions, and some forecasting and valuations and stuff like that. And because of that, we have some of their data and those kind of things. So why that data is important is when we can get that data in a consistent, comparable format, we put it all together and we can kind of spit out some averages like you're going to see today. For the most part, those dealerships are bigger dealerships. I think our smallest one is just under 100 million. But they're just one location. So that's a pretty good location, pretty good store for that dealer. Our biggest dealership is just over $1 billion. So it's amazing how fast that number has grown. I used to say our biggest dealership was in the $600 million range, and I thought that was humongous. So now we're in that $1 billion range, and they've got almost 30. Actually, got more than 30 stores, and things look a whole lot different. The rest of my firm works on agriculture, and so we are the biggest agriculture consulting and accounting firm in the country. At least we're the only ones that talk about how great ag is. So we're the only ones that have measured that we're big. So we can claim that as ours. So anyway, not only do the clients that I work with look exactly like you guys, but the clients that the rest of my partners in the firm work with look exactly like your clients. So hopefully we've got some data in here that will be good for you guys and something that you can take forward to help plan your dealership. Interestingly, I gave a webinar. I gave two, the same webinar, one internal for our firm and one for farm equipment several months ago, and it was more along the lines of economics. So today isn't going to be an economics lesson. But I thought it would be kind of cool to start here. And one of the things the one that we did internally, so to our firm's clients, I did with some other partners in my firm that worked with ethanol plants or worked with farmers or worked with manufacturers that our clients are. And so each of us gave a little bit of perspective. This was my perspective from the dealer's perspective. Since 2019, as you guys know, we have had record growth. So 2019 was pre-pandemic, and it was coming up, we had stuff we don't like to talk about back in 2014 and 15, recovered from that. 17 and 18 got a little bit better. And then all of a sudden 19 seemed to be when things were starting to look good again. And we were kind of back to some more of our normal margins and things like that. And then the pandemic did hit, and for some reason, since then, 19 was great, 20 was better, 21 was even better, 22 was a record, and 23, when we thought things would slow down a little bit, is still shaping up to be a pretty good year. Our supply chain along the way has obviously struggled to refill, and that all that meant to date was that you probably could have made more profit than you actually did. You just didn't have enough to sell. What it means going forward is now all that supply that was bottlenecked seems to have showed up now sitting on your lot. And you got to figure out what to do with it. We've also experienced a customer base in our farm clients that has had along the way record cash receipts and record cash expenses, and had a depreciation that was allowed by the government and the IRS that said they could bonus 100% of their equipment that they bought. And so it encouraged them to, because they were making a lot of money, and it encouraged them to go out and buy a lot of your stuff so that they could have a big tax deduction and that kind of thing. So that fueled your growth. Then recently, since May of 2022, we experienced something that we haven't really experienced in 20 years. And that was, we had an interest rate. So that sounds weird to say because there's always been interest, but for the most part, we had effectively a 0% interest rate. The government loaned money to the banks really cheap, and the banks in turn loaned money to John Deere and Case and Caterpillar and others pretty cheap. And so that got passed down to you guys. And so you were able to give pretty lucrative finance packages out to your customers at somewhere between 0 and a couple of percent. And so it felt like, if it wasn't 0, it felt like 0 to them. Well, since May of 2022, and inflation reared its ugly head, the government's been combating that with interest expense, and it's gone up and up and up and up and up, such that about today, you're probably offering financing to your customers somewhere in that 7 to 9% range. And while that isn't the 1980s, and some of you on the call might not be old enough to remember the 1980s, in the 1980s, the music was better, but the interest rates were terrible. They were 20% for your house. And so, that now your customers paying 7 to 9%, they think it's terrible because they've never seen that. But if they'd been back in the 90s, they would appreciate this as a fairly low rate historically. So that's something you've been faced, is kind of pulling that back a little bit. The other thing that's hurting particularly those of you that are farm equipment dealers right now, is they were negotiating a farm bill until things fell apart with the Speaker of the House race, or the Speaker of the House getting fired, and then them having trouble finding a new Speaker of the House. And so the House has basically not been talking to each other for a few weeks now, and that really took the farm bill from being talked about a little bit to not being talked about at all. And so it expired on September 30th. And, on the one hand, it's a good thing it expired because the old one had been around for a while and it really lost all its steam. Last year was really just crop insurance, which now that's really important. We need crop insurance when we have droughts and other weather events that make production bad, but it didn't have a whole lot of price protection left in it at all. And so we didn't need price protection this time a year ago, because during all this time, the other reason you guys had great sales is corn ramped up to $7+ a bushel, and now that's over the course of the last 12 months, that's come back down to the mid 5s, and it's projected to be down in the mid 4s by this time next year. So we need a new farm bill that's not just related to crop insurance, but we need some price protection for our farmers out there. And hopefully, now that the House has a new speaker, they'll start that working again. So I'll take a second to say it might have been partially Pinion's. We might have some credit of getting a Speaker of the House. I say that in jest only because I just got back from Washington, D.C. yesterday. We were there for a fly-in with the Associated Equipment Distributors, we were there for the annual fly-in to lobby for this industry. And the whole week, everybody kept saying, "Well, we'd love to hear what you want to lobby about, but we don't have a Speaker of the House, so we can't even talk about anything." Well, by the time we left, they had a Speaker of the House. And we're going to claim credit that was the Associated Equipment Distributors and Pinion who was there. They got that done. If the Speaker of the House is no good, we absolve ourselves from that responsibility now. So then the other thing is bonus depreciation. In case you didn't know, this year it's down to 80%. So you buy $1 million of stuff, you can write off 800,000. Where last year you could write off $1 million. Next year you can only write off 60%. So the same $1 million, if you buy it, you only get to write off 600,000. So while that impacts you guys as dealers a little bit, on your stuff, particularly when you buy, new fleet of vehicles, you buy a new building or something like that, it impacts your customers even more because they're not getting to write off everything they bought. We all know how farmers will spend, $1 to save 10 cents in tax. Just they hate tax that much, and so that's really helped us along the line. But next year, when that gets down to 60%, who knows what that does? There's some other tax stuff that sunsets and those kind of things. So I say all that because the economics of your dealerships, a few months ago, we were still cautiously optimistic that we were going to have growth even through 23 and 24. Now, 23 was, we were basing that on June results. June results, whether you looked at them year to date or rolling 12, were still records. And so everything was good, and we were quite certain that we'd have good growth even through the end of the year. And that meant that we probably have good, we would not necessarily have good growth in 24, but even with a pullback a little bit, just the amount of inventory and stuff like that would get pushed in next year because of normal supply constraints and contracts, we would still have a decent 24. I think we're still going to have a decent 24, but everything else around us right now, with the stuff I just said, as well as when you look at commodity prices, various sentiment reports from farmers, the stock market, which I don't know if you paid attention to that, but in the last week or so, it's ditched a whole bunch of space and hopefully brings that back. Disposable incomes are down. New and existing family home sales are down because interest rates are so high. And in general terms, inflation is still high, and inflation is still high, and interest rates have gotten even higher. And that's made doing business a little bit tough. And so you can see here that as of September 30th, when we look at all the indicators out there for our ag dealers, what we've done is we have actually pulled that back. Now that red isn't as bad as it looks. That red is sitting right at 0%. That's not negative, but the reason it's still in the red is because you think about it, your inflation is such that unless you get 5% or better growth, which is the beginning of our yellow line there, unless that's over 5%, your expenses are such that growth less than that is not growth at all. In fact, you're going backwards. So I'm showing these slides to start today's discussion from a standpoint of these things matter. Key performance indicators matter. Managing your business is going to get a little bit tougher if you want to continue to make the kind of money you've been making over the last few years. And it's not just a matter of, we did great the last 3 years, so I'm sure we'll do great the next 3 years, because that's not necessarily the case with these kind of constraints. So today's takeaways, we're going to look at a few KPIs. And for those of you who don't know what KPI is, that's a key performance indicator. So we're going to go through some of the definitions and calculations of those, some of the limitations, the industry trends. This looks like 3 different bullet points. All along the way, I'm probably going to put these bullet points together in our analysis just to say, what does it mean? What is the definition? What's the limitation? How does that look like the last several years? What has that done in the trends? And then what are the ones that I probably ought to pay attention to going forward? I put 3 quotes up here, that kind of, when I think about KPIs or your manufacturer's goals or winging it, what's best? Well, I think Mark Twain, I love his quote that there's 3 kinds of lies, damned lies, and statistics. Said another way, you might have heard a quote in there before, but I don't know who said it because I think we all make up a different number. But the quote is 87.6% of statistics are all made up. So that whether you can hear the pun behind that, but it's kind of the same thing that Mark Twain is saying. Teddy Roosevelt said, "Comparison is the thief of all joy." So, why that quote is up there is sometimes, while KPIs are great and they give us a way to say, what's my dealership look like compared to my neighbor or my competitor or just somebody in general, the industry standards and things like that. While that is an important thing to do, in fact, I think it's a very important thing to do. If not done right, all it does is tell you you're not maybe stacking up. And so we want to make sure that we've got our data in such a spot that we actually can compare it, because if we're going to steal our joy, let's at least get something out of it. So we don't want statistics and KPIs to be something that just steals your fun. Well, instead, what we would like to do is move towards what Peter Drucker said. Peter Drucker, if you guys have heard me say stuff about business books before, you'll know I say that he probably wrote one of the only business books that's authentic, and a lot of them copy off of him. But what he said is, what gets measured gets managed. And that's kind of what we're after today is what are the things that we ought to be measuring, and how can we measure those to know that's how we ought to manage our business going forward. Because as you can see over the last few years, winging it might have actually worked. I don't think any of us projected that we'd have the kind of growth that we had, and it happened anyway. So I told you earlier, we put our dealers' data together. As you can see, you're not going to see any of our dealers' names in here. We protected them there, but this is all our dealers kind of conglomerated together and shows you the average. And what you can see there is from 2018 to now. Actually, I went one slide too far here, where I put them out of order. Or I left it out, doggone it. I had a slide in here that showed what my revenue was. And over time, that revenue was a hockey stick growth from 2018 to now. And it's too bad that I don't have that slide in here. When by the time Kim sends this out to those of you that are attending, I'll put that slide back in. But anyway, there was a slide that showed our revenue. And it didn't matter if you were looking at new, used, parts, or service. All our revenue categories just grew like crazy over the last several years. Now, for some of my dealers, during that time frame, they had mergers and acquisitions. For only one of them, though, did any merger or acquisition wind up making them double their size the first year. So in other words, they merged in somebody smaller than them and were able to continue that growth. There was one dealer in there that was actually a couple of dealers that came together that resulted in a 50-50 kind of thing. So they actually did double, but they kept their double up. Now, we don't usually take that out because anymore, consolidations is just a part of life, right? And if you can't do a merger acquisition and keep going down the road to profitability, then, it was a cost of business anyway, more than just a merger acquisition. What this slide here, though, shows is what's happened to margins in that time. And take out the big ugly one in the middle that has kind of driven the others, and which being used equipment. You guys all know, as I do, used equipment is your different. That's how you compete in the market, right? It's whether you're taking in a trade and paying too much of it when you buy it, or whether on the second part of that trade you're getting rid of it for less than you paid for it. Either way, used is kind of one of those things that's just hard to manage. If I take that out for a second, though, you can see that my new margins did increase over that time, except for what's strange is 18 to 19, they went down. I probably should have started with 19, and my slide would have been easier to understand. But, part of the reason 19 was a good year was because customers were in the mood to buy again. We sold a lot of equipment in 2019, but sometimes the way you sell a lot of equipment is you don't sell it for as much as not the top dollar, but you sell it for what the market will bear. And that's kind of what happened from 18 to 19. But since 19, our new margins have gone up substantially. Our whole goods margin followed suit, even though our used kind of went down from 18 to 21, really. And it wasn't until the mid part of 2020 when we found out, holy cow, people are buying the heck out of our equipment. We don't have enough left. That's when margins really shot through the roof from mid 2020 to now, frankly. And those margins have been great. During that time frame, our service margin also continued to go up, as did our parts margin. Now, our parts margin, our manufacturers helped a little bit there. I say that a little bit in jest, but they helped by raising the price about 20% a year per year from 2020 to now on parts. And so our revenue looked really good for parts. Our margins have started catching up with us on parts because all of a sudden we're selling the parts that we paid extra for, not the parts that have been sitting on our shelves at the old prices. So that's just, again, a quick perspective on the last 5 years to say maybe winging it would have been, maybe results would have been okay, because we weren't talking about KPIs during that time, and you had record revenues and record profits. And now I see what I did wrong. I put the same slide in there twice instead of my revenue. So I apologize for that. Okay, so moving on, and past I won't have any mistakes the rest of my life, or at least the rest of this slideshow. So sales mix, what I'm saying here is it's kind of the first standard of KPI comparability. So sales mix is something we don't usually pay a whole lot of attention to, but when I start comparing one dealer to another, or even one dealer to themselves from a different time period, I really need to look at sales mix. Otherwise, the KPI analysis that I'm going to look at is very limited because I don't know what I'm comparing. Because as you can see here, over the last 5 years, while it's a few percentage points here and there, we go from in 2018, and what I usually do is I add the top two together, which would be my aftermarket of parts and service, and then I add the bottom two together, which is used and new, so that'd be my whole goods. So when I compare my whole goods to my aftermarket, I went from about 26% in 18, went up a little bit in 2019 and 20, but then I've steadily been bringing that back, such that as of now, these numbers are through 9/30 of 23 with my dealers. That number was under 20. Actually, it was exactly 20, 13.6 and 6.4. That's exactly 20%. So it's down 6% plus from the average of the dealers I work with during that time frame. But as a frame of reference, my biggest dealer set is big John Deere dealers, right? And so the whole good sales for them drives everything, and they sell a ton of equipment and a ton of a higher dollar. Especially my Midwest dealers are selling traditional row crop stuff. The price of a combine from 2018 to now hasn't doubled, but it wasn't $600,000+ back in 2018 for sure. So as that price of that equipment went up, it's not like my parts and service sales went down. My parts and service sales still went up, and that's why I wish I would have had the other graph to show you a second ago. That their parts and service was also a trend line up, but when I look at a percent of sales, it looks like my sales went down in that category because the percent of sales that went down. Again, that 5 or 6% doesn't sound that big a deal. If I had to start a dealership from scratch back in my traditional model, here on the very right, you'll see what those traditional best practice goals were. And that was, we'd have 30% aftermarket and 70% whole goods. And that whole goods, depending on where you are in the country and what kind of equipment you sell, that was typically 50/20, 50% new, 20% used. If you're in the Midwest, that number was closer to 50/50 or 60/40, on used to new. If you're on the coasts, that 20% used, that's way too high, because you might have some emission standards that your state doesn't even let you hardly sell used equipment. And if you're a construction more focused dealer, then your used sales also is down at the 5 to 10% range, and the rest of it's new. But for the most part, 70% on that whole good sales, excuse me, was what we were aiming for, and then 30% on the aftermarket was what all of our other statistics were made from. So you might ask, what's the big deal? Growth is growth, right? And market share is king anyway, right? We just got to keep selling more whole goods, particularly more new goods, so that we can, make the profits that we need to make and sell the equipment that our manufacturers are asking us to make. Well, the difference is, there is a big deal on sales mix, and not just from the standpoint of if your sales mix is 70% whole goods and your neighbors is 30% whole goods, we can't really look at your profit and compare it to each other, because as my whole goods goes up and my service mix goes down on my aftermarket, I'm essentially trading, what generally averages 42% gross profit on my aftermarket to 4.5% on my whole goods market. So that 10% shift from best practice to where we're at now, or the 6% shift from where we were at in 2018 to where we're at now, that 6% is a pretty big deal, when every dollar of that, we're taking from a 42% margin to a 4.5% margin. Now, granted, some of you guys might have different margins than that, but that's kind of an average. That's a pretty good average from our dealers that I see there. So, that's why this slide matters. Whether it's a 10% increase or 6% increase, either one of those makes it hard for you guys when you make a profit. Okay, then as far as expenses go, we had a big revelation, I think, recently, or we thought we were going to have a revelation that luckily didn't turn out too bad for most of our dealers. For a couple of our dealers, it produced a different story. I can't show you those dealers because that would be showing somebody's numbers. I can only show you my averages here. But that revelation was, for the longest time, we've always looked at the denominator of our sales or of our expense analysis was always sales. So, and I don't think anybody's different. Everything was expenses as a percent of sales, whether we were looking at fixed or variable, didn't matter. Total, we were always looking at as a percent of sales. Well, our sales, again, particularly on the whole goods side, has just gone gangbusters since 2019. And as that went up, of course our expenses went down. In fact, we were seeing expense loads. Our big dealers were always aiming in that 10 to 11% variable range, or I'm sorry, fixed range. And by the way, I don't know which dealership standard you are, but the accounting standards, I always feel like dealership expenses are different than what I learned in accounting school. In accounting school, we always learned that fixed and variable meant fixed was fixed costs. They don't move, right? They were the ones like rent and depreciation and things like that. If they were $100 for the year, we knew they were going to be $100 for the year. They weren't going to go anywhere. They were fixed. And dealership terminology, that's not necessarily so. Fixed expenses are more just my general and administrative and my overall expenses that aren't tied back to revenue. Variable expenses instead then just wind up being things like warranty and some commissions and stuff that you only have a variable expense if there's a sales that it's tied to. And so that looks a whole lot different than when I was in accounting school. That's an aside, because hopefully too many of you didn't burn all your brain cells in accounting school like I did. But where I was going with that was, for a dealership, again, a big dealership, 10 to 11% for fixed expenses was kind of our normal number as a percent of gross sales. Our gross sales went through the roof, though, and so what happened in 2020 to 2022 is that number, that 10 or 11% number, just kept going down and down. Our small dealers, that number that we usually aim for, was saying, somewhere in that 14 to 16% range. And so their numbers also kept going down and down and down. So what's happened is, and by the time we get to 2023, you can see here that the total expenses is sub 9%, not over 10 or 11, not over 14 or 16, but it's 9 point something percent. I think my lowest expense dealer right now is in the sevens. And that's a dealer that's pushing $1 billion. And so when I look at that and say, okay, have my expenses really gone down, or have my sales just gone up so much that it looks like I'm managing my sales pretty well? We tend to look at our dealers and do things like waterfall charts and try to understand, how does this year compare to last year based on your revenue and units and things like that. So that sometimes rears itself up. And from that, we could tell that our expenses as a percent of sales was going down, and our overall expenses were going down. And when I looked at my expenses as a percent of revenue, it wasn't increasing as much as my revenue. So we knew it wasn't terrible, but we were just wondering, where did it land? Did it actually go down or not? So on the next slide, I'm going to show you something where we came up with that. But on this slide, what you can see, though, that's just, we looked at, we tend to try to get as few accounts as possible. Whether your expense, your net income, your income statement, if it could be 6 or 7 pages long, it could be 14 or 15 pages long if you've got a different category for everything. But the key is you need to get that back down into some pretty big buckets. And so that's what you see here. We've got this back into these buckets here, and when I look at that, we can see, which one of those expenses did go up. Now you will notice that the bottom category on this one is my variable expenses. So like when I said right now that my variable expense, or my total expenses, are under 9, that's total expenses including variable. So the goal used to be kind of 10% fixed and 2% variable, and where our total expenses are below. Our total expenses are below even what our fixed expenses should have been before. And so that's kind of why we're looking at that and saying, did we lose anything? From this graph, you can see not very many of them moved that many percentage points, but it did come down, a full 2.5 points. Most, if I look at the big buckets in there, one of the biggest ones is going to be labor costs. And so when I look at that on this one, that is the big orange line, and it actually went down as well, 3.21 down to 2.38. That's how you know your revenue is growing a lot, is when it says that we're spending less on labor now than we were a few years ago, because everybody knows that is not the case. So what we say is probably a better analysis right now. One is making sure you understand your fixed versus variable. You might even need to make sure you're talking about it in the same terms we are. So, for instance, one of the things that sometimes we have to adjust on our dealers to put them up next to each other is where they're putting commissions, where they're putting where they're putting depreciation of their shop equipment or their rental equipment and stuff like that. And so it's kind of key to understand where you've got your variable expenses versus your fixed expenses. But what we've done on this page is not only broke out the fixed versus variable, and that's the little bars on the left of each bar. So they're graphed on the left, and that's where you can kind of see we're about 11% down to 8.47 and 2.13% right now. So that's that number. But what the big bars are on each one is we said, okay, let's take out this ginormous increase in sales and see what that expense would do if we start talking about that in terms of expense as a percent of gross profit now. And that would be total gross profit, not just on whole goods or not just on service or parts, but total gross profit. And you can see actually from our dealers on average, that has still down. So my fear was I was going to run this report and find out that, yeah, expenses as total of revenue had gone down, but expenses as a percent of gross margin had gone up, and we weren't seeing through to the real story. That is the story on some of my dealers. But again, I showed you my average on here, and what you can see is the number did go down, just not near as impressive as it's done as the percent of revenue here. So what you can see is my total expense as a percent of margin is 65.57%, 16.5 of which is my variable expense, and the rest of it being my fixed expense. So that's down from about 67.8 the year before, and and down significantly from what we called our first good year of 2019, which was 79.87%. So again, history is important. Not necessarily, history doesn't repeat itself, unless you manage it to repeat itself, kind of thing. And so what I'm warning people just is that, and we've been saying this for the last 3 years, is the way we've increased our salaries, the way we have increased our parts expenses and our service expenses and everything else, and then there's inflation on every one of those 14 buckets you saw on the page before. Your accountant like me is charging you more. Your rent and utilities have gone up. Everything has gone up. It's kind of the theory of everything. Everything has gone up. So to think we're going to manage for the next 5 years at this 65% of gross profit as our goal is probably not realistic. Somewhere back in that 79.87%, or somewhere between that and the 65 we're at now, is probably more realistic. Our sales probably aren't going to go backwards all that much. Inflation, is such that equipment dealers, we like to gripe about inflation, but a certain part of that is we can't afford for inflation to go down too much, or our used equipment all of a sudden is totally overvalued, which is kind of what we're seeing right now. So we will see inflation stop. I doubt we see much deflation, though. That's a bad thing. It seems like the only thing that deflates is the stock market, and it comes back every few months anyway. So, as you're thinking of managing it, I think it's important to kind of look at these historical returns and know that today we're probably not in a repeatable spot. The other expenses that I like to look at, which ones are really key? Well, so again, whether we look at it as a percent of revenue or a percent of gross profit, I tend to think gross profit is better. We've got that one on here. So, and that's how much are your employees contributing to your sales? So it's funny that forever, as a consultant, I always read things and told my dealers things that I read that said you should have $1 million of sales per employee. And we were never anywhere close. You can see we've got my average dealers on the bottom. I've got AED, which is the Associated Equipment Distributors, which is primarily, but not wholly, but primarily construction dealers. And then NAIDA, which is ag dealer, again, primarily ag dealers across the country. And so you can see we didn't get to $1 million until 2022. Now, some of my dealers did. And I think that was a function of my dealers were probably, there was a lot of consolidation in my group. And so we got to $1 million a little bit earlier in 2021, but we've been talking about $1 million of revenue per employee forever. One thing that we never did really talk a whole lot about, so nobody really knew what the number was what should be my gross profit goal per employee. I couldn't tell you what that goal was because we never talked about it until the last couple of years. We did start tracking it. And so now I can see, my dealer group has gone from about $124,000 revenue per employee in 2018 up to $176,000 in 2023. And at the same time, The AED ones went from 216 to 301. One of the reasons theirs goes up a little bit different is, on the construction side, there's a lot of rental. So on the gross profit, their sales aren't as high necessarily per employee as their gross profit is because of some of the equipment they're not selling, but they're renting a bunch. And so that gross profit shows up as a higher component. But it went up from 216 to $302 or 302,000 over that time. NAIDA's went from 147 to 161,000. I think the biggest difference between NAIDA and the dealers in my group. So I think it was about a week ago, NAIDA did their cost of doing business survey results here as part of the Farm Equipment webinar series. They kind of went through their numbers. So I just didn't have their numbers for the last two columns, but when I look at theirs, they had broke theirs out to small dealers, medium dealers, and big dealers. Big dealers being 100. I think they had a new category this year of $250 million or more, which is good. So it's kind of good to see the look through of that of the size of the dealers. I think for the most part, except for one or two of the dealers that I work with, they're all over $500,000, or $500 million. A million billion is only important in politics and taxes, I guess, but in dealerships as well. But $500 million, so the scale is just a little bit different. But even with that, they're the gross profit per employee on the NAIDA section and the gross profit per employee on the Pinion dealers they're very similar. In fact, they kind of cross paths, so it kind of shows that at some point in there, being a big dealer was also a better profit per employee. So that's why we got to 176 this year. Now, wages as a percent of revenue and average wage, I always look at those more. Of the first two columns are how are we doing efficiency wise? Do we have the right number of employees? Can we create the amount of revenue we need to cover the expenses and to cover our growth needs and things like that? And then the last two columns of wages, a percent of revenue and average wage, that's more of is that number enough? Is it repeatable? Are we paying our people enough? And are we spending enough on wages? Now that number, I'll say, is a little bit hard to read right now, especially the first column, wages as a percent of revenue. Again, because it's as a percent of revenue, and revenue skyrocketed the last 3 years. And so as revenue went up, I would have used to told you that if we're below 7 to 10% as wages as a percent of revenue, you don't have enough people. You're not going to be able to produce the same results you had in the first two columns because you don't have enough people to do it with. Well, that number now is 5.7%. And while we all would say we don't have enough technicians, we might not have enough salespeople, overall, we're not thinking that we're way understaffed, or we're definitely not way overstaffed. As you can see here, it's 5.7. Now, I don't think that's as bad as being under 7 as it's been in the past. I think if that's my average dealer, I think we're probably okay there. It'd be great. And NAIDA might have that in their numbers. I just didn't know how to pull it out of their report. So maybe in the future, I'll be able to find that. And then the average wage, I look at that one as saying, did we give our people enough increases? Did we pay them enough that they're happy and not going to leave us for the dealer next door or a different industry? And you can see there, this last year, between 2022 and 2020, or 9/30 of 2023, the number didn't go up very much. It went from $67,600 to $67,900, and that increase doesn't sound like much, but look at the year before, the 2 years before that. We went in 2020. 2020 went down, which is weird. From 2019, it went down to 2020. The weird part in that was COVID, right? We sent our people home for part of the year. They weren't any overtime being paid for part of that time because they were home and that kind of thing. 2018, I frankly don't know why it was $73,000 per employee. It doesn't really line up with anything else. I must have had a couple dealers that paid out really good bonuses that year or something. It kind of threw out the schedule. But what is real is 2020 went down because of COVID. 2021 went way up because of COVID, because not only did people get back to work and had a little bit of overtime, but they had a bunch of PPP and other COVID-related bonuses that showed up in their compensation. And then from 2021 to 2022, we got back to normal and we gave 10% wages. Most of you sometimes did that twice during 2022, and that definitely showed up, going from 61 to 67. And so it was bound to happen that at some point that would slow down a little bit, and it looks like it has. Now, whether or not that means we get to keep paying our employees at 2 or 3% raises like we historically did. I don't know, but hopefully it doesn't mean that we have to give out 10% raises a year like we did the last couple of years. So one of the terms that you hear a lot for expenses and KPIs is not just expenses as a percent of revenue, expenses as a percent of gross profit, or any of the others that I just showed you, but that's the term of absorption. At a high level, absorption is just if I look at my expenses and I say, man, if I didn't sell any whole goods and I only had to cover this up with parts and service contribution margin, which is basically parts and service gross profit with a couple of adjustments, am I at least covering it? So what we used to say back in 2018 and 19 was a great dealer was 110 to 125% absorption. So my smaller dealers always looked at me and wanted me to punch me in the face because I can't get to 110, 120%. If I got to 100, I'd be doggone happy. If I got to 90, I'd be doggone happy. Mark, quit talking to me about 110 to 125%. Well, what happened in the last couple of years is 110% is really hard for anybody to get now. And again, for the same reasons we just went over, and you'll see here that I'm saying actually 90% for an absorption target is the new 110%. In fact, I went through a bunch of our dealers and I ran the calculations. Okay, forget the margins that we've been getting lately, that those have been going up and up and up. Forget that part. Just look and say, okay, let's go with the same goal that we are going to have 20%, 30% mix in our aftermarket at those goals, but based on the revenue that we had. And what I came up with is about the best you can get to was 89%. In fact, most of our dealers would have come in at the 87% range. If I was just looking at that. And now the fact is they did have better margins than what we were getting. So instead of having kind of traditional margins of 33% gross profit on parts and 67% gross profit on service, they had a little bit better than that. And so you can see here the orange one of 91.18%. That's what the dealers that I work with had for absorption rolling 12 of 9/30/2023. So a little bit better than the 90%. The green one on the bottom, the 93.38%, that is a report that I have access to that's just all the big dealers in the country, the ones that have sales of 300 million plus. And when you look at that, those dealers and their number wasn't through 9/30, I don't get that quarterly, I get that annually. So that's through December 31st of 2022, which is a little bit different than today, but not terribly different. But through 12/31/2022, that absorption number was 93.38%. The 67 to 74% number on the top, that was the NAIDA number. If I look at theirs, and the 67% would have been their smaller dealers, and the 74.5% would have been their bigger dealers. And so you can see that number is somewhat different than the 90%. But one of the unfortunate things is there might even be some manufacturer representatives on this phone call. I didn't look to see who's on it today. But usually there's one or two on here, and the manufacturers got used to the 110 to 125%, and I know that they've been kind of pressuring dealers and saying, "Man, they're beating me up over by 95%, Mark. What's going on?" And it really is. They're still kind of tied into those old numbers, and they haven't thought through the sales mix part. So hopefully this message gets out a little bit that not that we're not saying there's less important to have great absorption. We're just saying it's almost impossible to get back to 110% based on the sales mix that we're seeing today. Now we might get back there again, but it's going to take a pullback in the sale of whole goods. The next question would be then, what about used inventory? What impact does that have on our stuff? So, I mean, there's 3 used inventory goals that I would tell people to aim for. And for the most part, for the last 2 years, we've got to ignore them all, right? You didn't have enough used inventory. You didn't have enough new inventory. And so we were out there buying extra stuff. Even before COVID hit, we had dealers out there buying a bunch of used inventory off of auction and things like that to bring into their store, and essentially flip. Yeah, and so used inventory goals, we didn't have to pay a whole lot of attention. So winging it kind of worked for the past couple of years on used inventory. Now I think we're seeing these through September, your lots are getting much more full. Some of you, even on the news side, you got equipment delivered a little past season and you got to sit on it for a year before you can get it sold, and that just makes your used inventory sit there that much longer. And so it's important to start planning towards these again. Now, some of my dealers, they're very aggressive. You know, a piece of equipment comes in and then the clock starts running. And they will literally put it on a schedule such that if they don't have that sold by the end of 18 months, or 12 months, in a lot of their cases, they've got the piece, the pricing on that set very aggressive to get rid of it and off their lot, because old pieces of equipment just get harder and harder to sell. So you're going to have to start doing some of that. Our goal would be that used inventory as a percent of total assets. That goal has always been about 30%. You can see my dealers at 930. My worst performing dealer was at 23, and my highest performing dealer was at 34. Now, I'll tell you that worst performing dealer at 23 wasn't my worst dealer. They had a lot of assets. They had a lot of cash still sitting there that they hadn't gone through. They had a lot of goodwill still sitting on their books, and so they weren't necessarily a bad dealer, but even with them with a big balance sheet, their used inventory didn't get over 23%, and then 34% as a max. The other part we like to look at is used inventory as a percent of equity. So now they're saying, okay, let's the way our inventory has come in over the last year, we've got more and more of that borrowed right now. So our equity is actually down right now for a lot of dealers, because I looked at a dealer the other day that doubled his inventory from December, and double for him is a big dealer. Man, he went from about $150 million of inventory to about $300 million of inventory. And because a lot of that had just come in, a lot of us floor plan, we had 70% of that borrowed. So all of a sudden my equity is down. So what's my goal if we used inventory as percent of equity? It's a lot higher than the 30% of total assets. It's 70%. And you can see that I've got dealers here right now at September 30th that are averaging 92 to 114% of their equity is tied up in inventory. Now, we hate it when that number goes over 100 for obvious reasons. But when that, right now it's a cycle that number is pretty high. And our best dealer in that right now, September 30th, was at 92% as a percent of equity. Then the other part to look at is used inventory as a percent of total whole goods sales, goal being about 20%. And right now that number hadn't caught up to us as bad yet, but it is. You can see it's below the 20% number, which is good. But at some point that there was a point last year where that number was way too low. So that's kind of been recovering a little bit, and now that's up to 12 to 17%. When I look at my dealership group. So used inventory, what this tells me right now is, and if I looked at all the graphs, yeah, used inventory is back. We're seeing dealers take stuff to auction right now. The aggressive ones are actually having 2 or 3 auctions already scheduled. Now, what's interesting is a lot of them are kind of staggering those out, saying I'm not going to have one big, $15 million auction. I'm gonna stagger that out. I'm gonna have 3 or 4, $3 to $5 million auctions, and not be, maybe the equipment pricing comes back, maybe interest rates go down, maybe I catch a better weather day, whatever that is. They're spreading that risk out of trying to have better results than having one big auction. The one big auction days back in 2014, that's when we got down and said, we got a piece of equipment that we would have sold on the lot for 100 million. We take it to auction, we sell it for 40 million. That's hard to recover from. 40 million, 40,000, 100,000, 40,000. Sorry about that. But regardless, that's too big of a number to recoup. And so we're seeing auctions come back, but not like they were back in the bad days. Another thing we then like to look at is not just used inventory as a percent of things, but what we call the used production rate. And the concept of used production rate is one that, if I think about John Deere, Caterpillar, Case, or AGCO, or any of them, they've got a bunch of economists on staff that say, hey, here's what you ought to be doing as far as the production of new equipment. John Deere looks at several different models and says, hey, here's what we ought to be producing. And historically, the dealers are also producing something, and it's called used equipment. Every time you sell a piece of new, you bring in a piece of used, and oftentimes back in the bad days, you didn't really have anybody looking at that. They were just, if we sell a piece of new, of course we bring in a used, and that number just keeps building. but really that's production, right? And so we didn't have anybody looking out over that and saying, what can we really handle? Well, we did kind of look at that and say, well, there is a number that algebraically we can come up with it and say, we are either making too much or too little inventory. And so that's where the concept of 74% came out. And I won't run through all the algebra with you, but what that algebra basically said was, if we produce more than 74% of our percentage of our gross profit on the new, we produce more than that in used, then we're not going to have enough used, or we're going to have too much used out there. And it's going to have more than a year worth of inventory on our lot. We're going to have to sell it for cheaper than we thought we were, and so much and so on. So that's too high. But if we produce 73% instead of 74%, or we produce 50% or whatever we produce, then that's too little. And we're not going to be able to put as much inventory on our lot to keep our lots full enough to sell it over the course of the next year to produce the same kind of results that we got from used the year before. And so our overall return will hurt. And what you can see is in the last couple of years, our number had got down well below the 74% number. And actually, even through September 30th, it's still below that. What the numbers here is 71.67%. That's, again, my dealers. The 68%, that's 2022's big dealer average, and the 61% would be NAIDA's 2022 average. So again, some of the smaller dealers out there. And so you can see back in 2022, it was still quite pronounced that we were well below the 74%, so didn't have enough used inventory, and you guys all lived through that. But that number, as you can imagine, has gotten back up, and I'll be curious to see where that winds up at the end of the year. But I would guess that it might be over 74% as we head into 2024, could be approaching, the 80 to 90% range again. When I know it's terrible is when we get to those times where we're producing 110 to 120% numbers, and that's usually from guys that have big multi-unit discount deals. They sell $10 million worth of equipment to a farmer, but they bring back in $5 million worth of use, and they don't have any plan to get rid of it. Those are the days we want to get past. Historically, as you can see here, I've got that slide in the wrong spot. Let me go here. I'm going to come back to that one in a second. So our other one is looking at return on equity. Okay, so we've got, do balance sheets really matter? And the answer, of course, is yes. A lot of you focus on net income, right? That'd be my return on equity here on this one. So if all I did was look at net income and say, hey, how much should I be producing? Guidance has always been somewhere in that 25 to 35% range for a dealer. That's way on the left. If you look at 12/31/22 for both whether you look at our dealers or NAIDA's, that was somewhere in that 45 to 46% range. Looked really good. That number's down to 35.86% for our dealers in 9/30. And why is that? Why? Because balance sheets matter. All of a sudden, our turn has gone way down. So right in the middle is turn, sales divided by assets. And you can see that number back in 2022 was 2.64 for us, 3.0 for NAIDA. Now that would have been overall turn. That would have been the balance sheet. That would have included the cash and the fixed assets and things like that. If you looked through it to used or to all inventory turns, then our number was actually over 4. And I don't know what NAIDA's was, but I think it was 3.9 something if I remember right. But our inventory, not just used but new and used in parts, it was turning pretty good. Now that number is down to 2.25, and primarily because our parts and our used and our new equipment inventory is not turning as fast because it's sitting on our lot a little bit longer. So that's the one square in the middle. The other ones on here are more related to net income, but they each show a little bit different out of that. The first one is contribution as a percent of sales, and the second is operating income as a percent of contribution margin. So kind of if you add those two together, that's what you normally kind of see as gross profit. When you separate them out, you can kind of see where they each come from. The net income. One would be gross profit and one would be net income. Yeah, when you multiply them together, and this will show you that for the most part you're getting 42% from your operating income, but then by the time we get down to net income, we're at 45% times 15%, or about 5 to 6% is where that's at right now. Then the farthest one on the right would be how much leverage am I getting on my balance sheet? And you can see we're getting a lot of leverage out of our balance sheet right now. Not as much back in at the end of 2022 because we didn't have as much inventory and we didn't have much, but it was debt. The interesting part of that though is the more you're leveraging, the more your return on assets or your return on equity is on the far left. So sometimes when you just look at return on equity, you can say, hey, everything's great. You might have got it all in the back of borrowing. So historically, what does that look like? And that's the slide here that I skipped. Our tangible equity over time has stayed kind of consistently. That's graphed on the left there. And for our dealers, that's ranged somewhere between 31 and 46%. And that's been coming down, though, a little bit since the end of 2022. So we kind of ramped up our cash through 2022. We've gone through some of it in 2023, and we've borrowed a lot of inventory. And so our equity is down at its lowest point, really, through the second quarter anyway of 2023 here. The return on equity is the yellow line. You can see that has gone up steadily over that time, which is great. Usually there's an inverse reaction, right? As our equity goes up, it's harder to make a return on it. But this was best of both worlds. Our equity was kind of going up and our return was going up. And now in 2023, it's the opposite. Our equity is going down and our return's going down. So we need to reverse that position, which means winging it probably isn't as easy to do as sometimes we think about it. And then finally, what I would say is when you've got your list of key performance indicators, and the ones that we look at are there on the right. A lot of these I went through today. Some of them are more related to breaking out what I went through today farther. Like, so for instance, gross profit is one. I want to look at that, not just from whole goods and parts, but I want to know the difference between new and used and parts and service and everything in there, right? And so I break those out a little bit. What we find is good is to look at those once we've got our set of parameters out there, is look at those from time to time, because I honestly believe it does you way more good to compare your key performance indicators to your key performance indicators this year versus last year versus history, versus spending all your time comparing yourself to your neighbor or your competitor or your enemy. Because then you go back to the quote I showed up earlier, that comparison is just the thief of all joy. I really want to know, am I making improvements? Am I having some stuff that I've got to get past and get back to improving? And those are really the answers you want to have when you're looking at key performance indicators. I throw this slide up there just to show you, there has been from 2022, the end of September, to 2023, the end of September, in our dealership group, you can start to see there are some things. So my dealers, I love them all, and you can see why. A lot of them perform really well. Last year, 9/30/22, bullseye. As far as looking at the key performance indicators, they were right there. They were managing by them. They were, most everything was in there. There were a few that were out. A few that they would tell you, hey, Mark sets the bar way too high, and there's no way I can achieve the gross profit used that he's got out there, the gross profit new that he's got out there. And so those were outliers. I'm okay with that. I'm going to keep focused on these others. There was a few that were starting to slip a little bit, like absorption and things like that they wanted to understand better. And that's why we started looking at some of these indicators a little bit differently, like I walked through earlier today. But what you'll see here is a 9/30/23. Even with good profits through 9/30/23, you start to see there is some scattering there. And as good as those dealers are managing things, there's some stuff that's starting to slip a little bit. So now not only is absorption out there, in fact, absorption actually got a little bit better, probably because I told them last year that the absorption, we need to focus on it. And now they've made some improvements. But and that's kind of the thing. When you focus on one, sometimes you forget some others. And what happened this year, as you can see, we've got some inventory key performance indicators that have slipped out. Our used and new ones they're still out there, maybe a little bit worse, but we've got, our return on sales has gone out a little bit. Our tangible equity has slipped a little bit. And so, just doing business and still doing good business, even then, comparing myself to myself, I can see that I've got challenges this year. If I compared myself to somebody else that wasn't having challenges, that would steal all my joy. If I was comparing myself to somebody that didn't know what the heck they were doing and they were way worse than I, it'd tell me that I didn't have any problems to focus on, and I would also be wrong, and then I would be my joy would be gone next year because I didn't focus on it. So again, the key of this slide is just to show you, hey, find out what yours are. Talk to some of your dealer friends or your 20 group or whoever. Call me if you've got a question. We can kind of walk you through some of those. But regardless, you need to know what those are and then start managing to them. And with that, I think I have run out of time. I've got a contact list up here. Kim, I don't know if you want to take back over. If there's any questions, I can stick around for a few more minutes, and if not, we can let them go.
All right. We don't have any questions at the moment, but if we could give it a minute, if anyone had any questions for Mark, or like Mark mentioned, his contact info is up on the up on the screen if you want to just reach out to him personally.
Kim will also have a copy of this that she'll send out, and if you send any questions to her, she's always good about getting them to me too, and then we'll get a reply out to you.
Yes, I will be sure to connect the dots for anyone who reaches out to me directly for Mark. I'm going to stall a little because the last webinar, the question came through right as I wrapped things up. So you can still submit it while we're still talking. Like we said earlier, we are recording the webinar. The replay will be available likely on Monday. And keep an eye on your email for when that's ready, and it'll also be in our eWatch newsletter next week. All right, nothing's come in, so we'll wrap things up. Thank you, Mark, for joining us, and thank you everyone else who tuned in, and I hope everyone has a great weekend.